Now, with a rising rate cycle coming in, we also will expect that your cost of funds for banks and NBFCs will start creeping up. Goldman Sachs in its latest note has said that lending institutions have seen a benign funding environment, especially over the FY20 to the FY22 period. In fact, private banks have continued to gain market share. Depositors have kept their money in shorter term deposits, and that's led to a drop in terms of the cost of funds. In fact, banks have seen cost of funds drop by 130 basis points, which is 1.3%, and NBFCs have seen a drop of 1.7% in their cost of funds. Now, what's happening is that credit growth is back. Your loan to deposit ratios are exceeding 100%. That is, banks and financial institutions are lending more than taking in deposits, and there is a slowdown with regard to a market share shift which state-owned banks have started, with the state-owned banks starting to grow. There's also a shift in maturity buckets. People are preferring higher maturity products, and there's a tighter loan to deposit ratio. The impact of this is there is a moderation in CASA expected going forward. There's going to be a shift to term deposits. That's the impact. And there is already a starting cycle of rise in money market rates. So what Goldman Sachs believes is this will also lead to an increase in cost of funds by at least 1% by FY24.